So Andrew, we've talked about different types of annuities in our prior videos. We've talked about variable annuities. We've talked about immediate annuities. We've talked about a fixed annuity. But today we're going to focus on a particular type of annuity that has become very, very popular over the last, I would say, 15 years or so. And that is going to be a fixed index annuity. Now, these annuities have become very popular, and we're going to talk about why that may be in today's short educational video. So everyone tuning in, you're going to want to stay locked in today to understand what is a fixed index annuity. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea. And we do this by incorporating a team of strategic partners ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a comprehensive and holistic retirement roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrea, according to the Investment Company Institute, individuals hold about $2.2 trillion in annuities. So of course, with that number being so enormous, maybe not so much for our government, but for us regular folks, $2.2 trillion is a huge deal. And that is the approximate amount that individuals hold inside of annuities. So annuities are a big part of retirement planning if you're trying to safeguard from running out of money too soon. Now the question is what type of annuity is going to be relevant for you? And I would say since 2008, Andrea, a fixed index annuity has become extremely popular for a lot of retirees and people who are trying to build a retirement income plan that's going to last. Because with a fixed index annuity, it kind of has elements of both worlds, where you have protection in case the market actually goes down, but you also have the ability to have really nice growth if the market is increasing. So we're going to talk about some of those elements today. Now, Andrea, we've actually piggybacked off of the great Warren Buffett. I think we should actually give homage to him in this video because his 2 rules for money was to never lose money. And then his second rule was to always remember rule number 1. But Andrea, as you know, we have 2 rules of our own that we always give to our audience every week. And what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
So let's go ahead and dive into our video today to try to understand what is a fixed index annuity and should you have one or not. So let's go ahead and talk about a fixed index annuity and exactly what that is. So a fixed index annuity is a very unique type of annuity. And there's some really unique features to them. So let's go ahead and talk about the ins and outs of this particular type of plan. So FIAs that's what you may hear them commonly called, FIAs or fixed index annuities, is a type of annuity that pays interest based off the performance of a specified market index. So it can be like the S&P 500, or it can be a less common index like the Barclays or indexes that you make, the JP Morgan Mosaic, things of that nature. It can be based off of those type of indexes as well. But basically what you're trying to do is get a certain percentage of that index inside of a fixed index annuity. You may also hear these called equity index annuities as well, or EIAs, because they're equity based. They're based off a market return. But how do they compare to other common annuities that you may hear out in the marketplace? Well, fixed annuities, of course, we've talked about that in other videos, but a fixed annuity is more like a CD. And so with a fixed annuity, what you may see is a guaranteed rate. It may be 3%, it could be higher, it could be lower, depending on the company that's offering it. But it's going to be more short term. It's going to be maybe 2, 3, 4, 5 years out, and you're going to have it based like a CD. Then you have a variable annuity. Now, variable annuities, they base their interest rate on a portfolio of securities. So you're looking at stocks, bonds, and mutual funds that you may see inside of a variable annuity. But when you're talking about a fixed index annuity, the way we look at it in our office is more as a hybrid because it has elements of both types of annuities that we've just discussed. Because you have the protection that's provided by a fixed annuity. That means you're 100% protected. You can't lose any money inside of a fixed index annuity, much like a fixed annuity. But you also, because you have that market link, you have that fixed index annuity linked to a certain market, you can also expect potentially higher growth than you would see in a fixed annuity, much like you would see inside of a variable annuity. So it basically has elements of both. Now, all these types of annuities, just so you understand, all of these types of annuities will be able to provide you lifetime income if you set them up that way. But what I would encourage you all to do is just to go back and take a look at our video that we did on types of annuities so you can get a better understanding of the different types of annuities that may be available to you as well. So let's go ahead and continue to add to our discussion here about a fixed index annuity. One of the things that I think is really important if you're going to ever buy one of these types of products, you should understand these contractual terms, because these are very, very important to understand. So the first thing I want to point out are caps. Fixed index annuities have caps. And basically what a cap is that it's going to limit the amount of interest that you can possibly earn inside of that particular contract up to a certain limit. So for example here, let's just say you have a fixed index annuity and it has a cap of 5%. And that index actually earns 6%. Well, you're only going to get 5%. That's the cost of actually having a product that's going to give you some upside potential, but also eliminate your downside risk. But let's just say you have the same annuity and it has a cap of 5%, and that index earns 4%. Well, you're only going to get 4%. You get up to the cap. Anything from 0 up to that cap is what you're able to earn inside of a fixed index annuity with a cap of 5%. Like I said, depending on the company that you're utilizing, that can be different from company to company, of course. Also, just so you know additionally here, you can have companies that have uncapped options when it comes to index annuities. So understand that. You want to have an agent that's very knowledgeable with this particular product to help you understand the best terms and the most favorable terms for you if you're going to look at adding this to your portfolio. Another term that you're going to look at is participation rate. Of course, a participation rate is similar to a cap, except it's going to limit your upside potential based off of the percent, a certain percentage. So for instance, in this example, let's say you have a participation rate of 40%, that index earns 10%, where you're only going to be credited 4% inside of that contract. And if that index had gone up to 20%, then you're only going to be able to get, of course, 8%. You're only able to get 40% of whatever that index actually is able to earn. You have a 40% participation rate. Also understand, additionally, you can find companies now that has a 100% participation rate, or even 110 and 115%. Some as high as I've seen is 140% participation rate. So that means that you get 140% or 120 or whatever that participation rate is of that particular index that you're allocated to. So like I mentioned, you want to have someone who's knowledgeable, who can put your best interests in play when it comes to looking at these types of products. And the last particular contractual term that I want to discuss with you is a spread. Now, spreads are really unique because it basically deducts from whatever return that you may get inside of a fixed index annuity. Understand, there are some annuities, that you can get into that have all of these three things going on at once. So you have to be very careful of what you're doing in that particular situation and make sure your advisor understands that you're trying to understand what terms are you getting into when it comes to your particular fixed index annuity. But with a contract spread, it basically, let's just say you have a spread of 2%. So they're going to typically give you a spread of 2 or 3, and maybe and less than that. It could be, of course, more, as I mentioned. But let's say your index earns 4%, and your contract is only going to be credited 2% because you have a 2% spread. If that index were to earn 6%, then your contract would have earned 4%. So whatever your spread is, they're going to take it away from whatever the return is inside of that fixed index annuity. So for all terms when it comes to a fixed index annuity, no matter what type of strategy that you have, if there is a year where the marketplace is negative, you can never do worse than 0. So in this case, you may hear this all the time, 0 is your hero. The market drops 20%, you're going to have 0. So let's look at this. So let's say in our first example, we mentioned you having a cap of 5% inside of an index annuity. Then if that index went down negative 6%, your return is 0 for the year. You don't lose anything. Let's say your participation rate was 40%. The index went down -10. 0% loss. So you have a spread. You have a 2% spread, but the index earned -4% for that year. 0% loss. So none of the contracts, no matter what you have in place, will have a loss assessed to it, no matter what the contractual terms may be in a negative year. One thing to note is that these contracts are usually calculated on an annual basis, and the terms for these contracts are going to be 5 to 10 years, depending on the state, and depending on the type of annuity that you get into. So you have to understand that when you're talking about a fixed index annuity, or really any type of annuity, you're looking at it for the long haul. You're looking at it for safety, security, and income. So I wanted to quickly take a look at this chart for our last slide here. We can look at take a look at this from 2000 to 2020. We're comparing a fixed index annuity to the S&P 500 with dividends, and that is allocated towards the S&P 500 index with a 40% participation rate. So you can't have any losses during any of the down years that we saw between 2000 and 2020. Take a look at $1 million invested inside of a fixed index annuity or an FIA compared with the overall marketplace during that particular time. The marketplace did outperform the FIA, but that's what it's supposed to do. It's uncapped. You can get as much returns as the market is going to allow, and with a fixed index annuity, you have a 40% participation rate off of whatever the S&P 500 is giving you. But with that being the case, because there are no losses that are ever placed inside of a fixed index annuity, look how close of the returns are to the overall marketplace. So when you're thinking about a fixed index annuity, one of the main things that you're going to want to know is that, of course, it's going to provide you safety over first and foremost. Also, it provides you balance. So if you want to be aggressive and you say, look, I want to have a portfolio that has, stocks, bonds, and mutual funds, that's great, but I still need to have some balance, but I don't want to have bonds that may not be returning anything at this moment, then a fixed index annuity can be a great complement to provide balance in that portfolio. And then, of course, it helps you sleep better at night. It gives you peace of mind. Anytime you can have any product that can eliminate the downside risk of any turbulent market, that's always going to give you a peace of mind. As we always note, you're going to always want to consult with your own financial advisor or tax advisor just to make sure that any decision that you're going to make about any product is going to be suitable for you. So I really hope that information gave you some really good insight into what a fixed index annuity really is and how you may want to implement that into your own retirement income goals. Please remember that these videos are created for educational purposes only, and you should always seek out your own financial advisor or tax advisor for your own particular situation. For more information on this subject matter or any of the topics that we've covered in our prior videos, feel free to reach out to our office or leave any questions or comments in the section below.
To learn more about our services and how we can help to increase your chances of not outliving your retirement income, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.